Good day, Jay. What's your view to the markets today?
Die Stummschaltung ist aufgehoben.
Good morning to you, Jens. Good morning, guys. Happy to be here. Thanks for having me. Sorry for the voice. I've been sick for a week now, and I can't get rid of it. Sucks. But it is what it is, and I'm back in the markets. I was gone for a week, like I said, actually more like 9 days. So I'm catching up on what's going on as well. Risk disclaimer is, of course, in full effect. Here's me. And the last trade is a couple of weeks old. We were looking to short the pound versus the Canadian dollar. And you were able to make some money, as you can see here. Maybe you can't. Hopefully you can. We got into the zone where we were looking to short, and we almost hit the full profit target. Then we had a reaccumulation of a long, and then we're still trading in the box there. Right now, we're in the middle of the middle, so there's nothing to do for us. Hopefully you were able to get some pips out of the trade. Again, sorry for my voice. Headlines this morning. We have we had a risk-off picture in Asia, which as soon as London opened, turned a little bit. We did have Asian equities lower after the sell-off on Wall Street on Friday. We saw some disappointing data. The non-farm payrolls missed. Overnight, we had some disappointing Japanese GDP third quarter negative revisions, and we had some negative, significantly negative Chinese trade data. So the trade war between the US and China is in full effect and having some negative impact over in China. We saw Australia being let down by the tech and the fin sector financials. We saw the Nikkei suffer from a strong yen risk of inflows into the Japanese yen. And like I said, there was a worse than expected revision down in the third quarter GDP growth number. Shanghai and the Hang Seng, bad performance based on the Chinese export and import data. And the trade war is having an effect, like I said. Let's stay with the trade war for a second. We had U.S. Trade Representative Lighthizer stating that the 90 days that they agreed on during the G20, market was quite happy initially. We had a risk-on rally. We saw Aussie dollar rallying. We saw the U.S. equities rallying. It was very positive. We had the assumption that the Santa Claus rally was starting to finally kick into gear. But now Lighthizer said that the 90 days period was a hard deadline. And parallel to it, and I don't know if you guys have that on the radar, the chief financial officer of, I don't even know how to pronounce it, Huawei, was arrested. And so the Chinese had actually the US and Canadian ambassador summoned by the government, and the CFO was arrested based on fraud charges. So that's another needle that the Trump administration is sticking into the Chinese right after the G20, where the markets were under the assumption that, hey, we are relaxing this bullshit a little bit. Let's make some money. Not so fast here. Unfortunately, the risk off sentiment is taking hold. Over in the UK, what a goat fuck. Excuse my French. I mean, Prime Minister May definitely is not, I mean, the market is fully pricing in that she won't have a chance to get her Brexit deal through Parliament. So over the weekend, she held discussions with some EU leaders regarding postponing the Brexit vote, which is currently still to be held tomorrow, December the 11th. Now, to recall, she needs 320 votes. That's going to be a very tough one. And I prepared a full slide on this, so we'll dig into that in a minute. If she gets voted out, if she has a vote of confidence brought to her by the opposition party, et cetera, if her deal fails in Parliament, then Boris Johnson, Raab, and McVeigh are all already posed to aim for the leadership of the UK. Oil, we had this long-awaited December 6th, prolonged into December 7th, OPEC meeting. 1.3 million barrels reduction were priced into the market. That was the assumption. They came out with 1.2 million barrels per day reduction for 6 months. Price actually rallied. It rallied because it came close to what was priced in, and we had a lot of volatility, a lot of headlines, went up and down, and initially rallied all the way up to 54, and is currently, when I prepared the slide, it was trading around 52.5. Russia came out over the wire, and they said that they see their optimal oil price at 55.66. So we know that Trump wants a lower oil price. We know the Saudis need a much higher oil price to balance their budget. And we now have a target range for the Russians, 55.66. So it's going to be interesting. I love the volatility. It gives us a great opportunity to make a lot of money. And I hope you guys are digging into the oil market and are reading up on these bits and pieces. It's a lot of fun to trade oil. It's fast, it's violent, it's dirty, and it gives you a lot of opportunity to make money. Of course, we also have the Italian budget debacle on the radar. The Italian-German 10-year spread came in a little bit at 2.906, but we printed a new high November 20. We took out the former high at 3.38 and we went to 3.385. And I still have that 4% target on the radar if they mess that one up, which they could. Risk picture overnight in the currency G8 market. What's strong, what's weak? Mixed picture, really. Australia initially came off, might be a data bug here, but I did see the Dixie, the US dollar, recovering a little bit. And like I said, the risk picture started changing early on. Let's go through the slides. Let's see if we have time afterwards for that. We don't really have that much on the data docket for this week. We have ECB. We have really the main culprit this week is going to be the Brexit and the vote tomorrow. That offers us as traders the highest opportunity to make money in terms of volatility. Okay, so Brexit. Here comes the slide. You guys ready? This boring, really tough topic of Brexit, and it's like 1 minute after another guy steps in front of the mic and sound bites are moving the market. The pound is reacting less to economic data and more so to this Brexit vote debacle. So Tuesday is the vote. 320 votes are needed. May has 100 conservatives of our own party already who said that they're going to vote against the bill. Impossible to pass. So our friends over at HSBC, they plotted out some scenarios for us. Thanks for that, because it actually helps. So let's say the deal passes. That gives the market clarity on the transition, but not really on the terms. But still, we have some clarity on the transition. That's good. Markets hate uncertainty and price accordingly. But then still, we have the risk of a general election, likely due to conservative DUP pact being weak. This conservative DUP pact that May is riding on has only 8 seats in our favor, okay? 8 seats. So you can't really lead a country with an 8 seats majority. Business investment were to grow, that's for sure, and cable would be expected to rally to year end to around 1.38, and in 2019 all the way to 1.45. And of course, the expectation would be for the Bank of England to hike in May by 25 basis points. So that's if this thing passes. Probability roughly nil. Okay, let's say the bill passes after initial rejection and back and forth and bickering, and it passes with amendments and Labour Party support. Whoa. Then we definitely have a risk of a general election because maybe we'll be seen as weak. Cable will initially rally, but then it will falter because of political uncertainty. And help us God if the socialists take over Britain. And I'm not being political here. It's just going to be economically in the long term, not the best thing to happen. But we'll see. We would get slightly lower inflation getting priced into the market. And that means we would also probably see modestly higher consumption by retail. Business investment would increase. So again, there's a likelihood that the Bank of England would hike in May. If you don't like scenario planning, this is the wrong job for you because this is what we do all day long. That's what we have strategists, analysts. This is what we do. We pre-position accordingly to an event that has the highest probability of happening. So maybe this has a slightly higher probability of happening than scenario 1. Okay, what if the bill fails to pass, which the market currently expects? Then we have uncertainty. Volatility may increase a little bit later because that is the scenario that's being priced in right now. So potential Conservative Party leadership challenge, obviously. So, you know, all these other guys that I mentioned early on were to go for the leadership job. And or we would see Labour Party tabling a vote of no confidence. Bad, bad, bad. So then we have a potential extension of Article 50 and or we see a second referendum, which I always thought might be a possibility, and or Parliament could push for what's called the Norway option. That's how Norway is dealing with the Eurozone. So that's what we call the Norway option. and or we see general election, and or we see a chaotic no-deal Brexit scenario. Business and consumer confidence would falter. On the back of that, GDP growth would falter. Cable would be heading down towards 125. That would lead inflation higher, imported inflation due to a weaker currency. That means rate hike expectations would be getting priced out of the market. Goodbye, cable. Great short. If that happens, you sell top edges. Currently, the market expects the deal to be voted down. So cable is trading in a box. I think this is a weekly chart. So the main decision points that we currently have is 128.5 above and 126.5 below. We are in a wait and see mode until tomorrow. We have longs, we have shorts. It's not quite clear right now, the picture, trading in a box. Marcus, I hope you're watching this. He's our specialist for box trading. Data that came in this morning, as you can see, red, red, red. End of the week, we have labor market data. And the really only important thing here is if the wage growth component in terms of percentages continues to print above 3%. If that were to come off as well, that would be an indication that potentially pressure within the labor market, positive pressure, would actually come off a little bit. But the picture is getting less positive. That's what I want you to take away from the slide. I want you to have a look at the scenarios. I want you to follow tomorrow, even if you're a technical analyst. Forget about technicalities for a second. This is something where you can actually learn how the big boys trade. In our market, in our banking market, the liquidity has drained a lot in the pound. A lot of market makers from the big boys are not giving the market their liquidity because it's quite uncertain what happens next. That's why scenario planning helps us. Okay, so really, really good opportunity, and the trade that I picked out goes accordingly. You'll see in a minute. Thanks for your patience, guys. Dollar, what's happening over in the States? On Wednesday, we have inflation numbers. CPI expected to come in flat versus 0.3 last time. On an annual basis, that's 2.2, so weaker than the 2.5 that we saw in October. On the core side, we see 0.2 versus 0.2 and 2.2 versus 2.1 last month. Why? What's happening? The reason is gasoline prices, guys. Gasoline came off by 8% last month, so obviously that is reducing inflation. The core measure is expected to range between 2.1 to 2.3 on a year-on-year basis going forward due to gasoline trading at a different level now, okay? Friday, we have core retail sales. That's also expected to come in weaker at 0.2 versus 0.7 last time, and on a month-on-month basis, 0.1 versus 0.8. Although the lower oil prices leading to lower inflation could actually cause retail sales to grow at a solid pace, so we have what we call upside risk. The number that's expected right now is pretty low, all right? So that would speak for a weaker dollar. When we say upside risk, we mean, hey guys, actually the number could come in a little bit higher than what's being priced in, i.e. 0.2 versus 0.7, and then you were to see dollar strength on Friday on the back of it, okay? Hopefully that is clear. Last but not least, on the euro side, we have Thursday ECB main refinancing rate. That's expected to remain unchanged at 0. And we have a presser. We have a press conference. That's great. That's great. We have the asset purchasing program to end. That is well known. So the focus will be on Eurozone growth outlook by the ECB itself. Last time the wording was that the growth outlook was broadly balanced. Now, please be careful because wording is everything when it comes to central bank communication with us, the market. If they switch to a wording tilted to the downside, that would be bad for the euro. Data since last meeting. German third quarter Q&Q GDP came in not much worse, but it came in worse than expected at negative 20 basis point for an expectation of negative 10. So German economic growth, like I said to you guys over and over and over again here in the last few months, we're seeing Eurozone growth and especially German economic growth stopping. The ECB and the German Bundesbank, they're very eager to say this is only temporary. Well, That's to be seen if it's temporary, but it's dragging Eurozone growth lower to 0.2%. So we have something that's called the economic staff projections. And the market will focus on these staff economic projections in terms of the GDP growth for next year. If they revise, the ECB staff revises their growth outlook for next year below 1.6% growth rate, that would signal to us, the market, a clear shift that the ECB is getting more pessimistic about economic growth in the Eurozone. Again, that would be negative for the Euro. So focus during the press conference will be questions regarding the bank's reinvestment policy. So the asset purchasing program means that the bank bought, for example, mortgage bonds, corporate bonds, government bonds, Italian government bonds, for example. So the ECB is the holder of this debt, of these bonds. And of course, they get repaid when they mature. What does the ECB do with that money? Because that money getting reinvested is, again, a stimulus for the economic, for the Eurozone, okay? So here, 2 points are important. Last week, they told us the new capital key. If you don't know that, Google it, ECB capital key, and see according to what percentages the ECB reinvests this money in the different jurisdictions. And they have an open-ended time horizon. That's important. It's different from what the Fed is doing. The Fed clearly stated from this day onward, we're looking to reduce the balance sheet, shrink the balance sheet by that and that amount. And we're watching that carefully on a weekly basis over in the States. Other points is the TLTRO. What is a TLTRO? We already had that twice. It's quite funny that for a few weeks now, the ECB is bringing that back up. It's basically refinancing banks, helping banks to make money. So TLTRO 2, that was the second program last time. Eurozone banks were allowed to come to the ECB and borrow in the amount of 30% of their outstanding loan book. So if the bank had a 100 million outstanding loan book, it's a super simple example, they could go to the ECB, say, hey, we have 100 million in loans, that's our loan book, and we can borrow 30% of that from you at a dirt cheap, ridiculous level. In fact, at one point in time it was negative, i.e. the banks were getting paid by the ECB to get an additional 30% in terms of loan money and loan that out. Free money from the ECB to the banks. You need to understand how crazy that is, okay? Then during the pressure, there of course will be questions about timing of rate hike. Currently the market is expecting the ECB to hike September or slightly later of 2019. The question will be, there were some rumors that they would hike the deposit rate first. And of course, we're going to have an eye on the Italian budget. They're going to ask about the Italian budget again. Okay, so in terms of positioning, the Aussie dollar fired along. At the time when it looked like the trade war were to calm down, the Aussie dollar appreciated. So that was a good signal at the time. Kiwi, same thing, extreme positioning. There was no immediate trigger. It was basically rallying alongside the Aussie. Yen is currently on its way to a long signal. We don't have a signal there yet. Volatility for the euro came off a little bit. Pound increasing naturally. Volatility means we're ready to make some money, guys. And on the yen side, came off a little bit. VIX overall obviously increased due to that somewhat violent sell-off last week in US equities. Option pricing for this morning, we're bullish on the dollar yen. That is performing nicely. Bullish on the euro pound. We hit into a top edge, so it's coming off. And gold due to the risk off scenario. Bearish for Monday, London session, euro yen. Option flows indicated for Monday, bullish euro, yen, Swissy, gold. Clearly a risk-off scenario. And bearish Monday, pound and Canadian dollar. So what is my trade that I'm looking at for this week? We had a great track record. I think we had 5 or 6 winners in a row. This week, I'm back from vacation. So I just got back into the market. Take this one with a grain of salt because I'm not fully in sync with the market yet. That's another thing if you're new to trading. If you're on vacation a week, 2, 3, and you come back and you think you can start up the market and start trading, you're an amateur. You're a gambler. I have no clue what's happening. I missed all nuances of last week. I need a few days to get back into everything. I need to read up on everything. I need to see how the market reacted to different news, to different economic numbers. I need to check if I missed any statements from central banks. It's a lot of shitty work that I have to go through right now, but that's my job. At the end of the day, that's what I get paid for. This is a profession. It's not a hobby. A hobby costs money. Profession makes money. Potential trade this week. I'm looking to long euro versus pound. My intention is that the pound's going to get smashed by all this fuck up happening over there. Excuse my French. And the beneficiary may be the euro. Pound Brexit. They're going to mess that one up big time. That is my expectation. Euro ECB will be eager to sound positive, and or the PMIs are expected to come in okay-ish on Friday. All right, Friday is square up day. Could have potentially looked at yen. Yes, short pound yen could be an opportunity off of top edges. But I wanted to look at euro pound because I want to personally get a feel for euro. And you don't know shit about the market until you have a position. And I need to get a feel again for euro and pound. That's why I, Jay, look at this market. Doesn't have to be the best trade for this week. I hope you understand that, okay? Now I have it on the radar. The yield differentials are telling me on a higher time frame that we're looking to go longer. All right. Risk to my trade is the Brexit. May come different from what I'm expecting, and or the euro numbers come in weaker than expected. So currently, this is a 1 hour chart. I'm looking at a roll reversal, at a daily pivot. I'm looking at an ADR low. I'm looking at liquidity. I'm looking at all kinds of reason to long around 89.30 if I get there. Now, I could be longing into a short. I'm hoping not. That's why my stop loss is quite close at around 88.93. My profit target is 90. Could actually go through 90. There's another level of liquidity above us. It's going to be interesting. I'm happy to take a look at this trade and get a feel for the market again, but that's what I'm looking to do. Have it come off a little bit. Hopefully, I'll see some reaccumulation by the big boys, and then off we go into a top edge. That's it from my side, guys. I haven't looked at any questions. Jens, I don't know what we're doing on time. I'm completely...
So time is our limit always. Thanks for the nice, great webinar, and your voice sounds crazy. I guess you need to go to bed back. But thanks that you did it. If you'd like to see and watch that again, in a couple of hours later, it will be available on our YouTube channel. Just go to youtube.com/AdmiralMarketsFX. And this is real-time daily trading days. We have 5 days a week, 5 different traders. So tomorrow, another trader, another style. Hope to see you all again. Greetings from Berlin office. All the time, good trades. And don't forget, important market event. Let's see how it goes. Tomorrow is the Brexit voting. So it can have a big storm on the market, or maybe not. We will see tomorrow. Greetings. Bye-bye.
Thank you guys for coming in. Thanks, VT and Freddie and all the traders. Thank you for the wishes. I'm going back to bed with the laptop now. Bye.